All right, let's jump right into this. Today, we're putting on our cautious financial advisor hats because, look, if you've been opening up your trading apps lately, you already know the market is absolutely buzzing right now. But to really grasp what's going on, we have to look way past the daily hype and understand the massive, shifting currents moving just beneath the surface. Welcome to the 2026 Crypto Iceberg. Just take a look at this number. 275. According to recent summaries, we're literally seeing 275 different tokens surging today in this massive, sweeping bullish trend. Traders are openly talking about a $100,000 rally for Bitcoin. And honestly, this visible tip of the market iceberg, it's undeniably thrilling. It's exactly the kind of momentum that triggers instant FOMO. But as disciplined investors, our job isn't to chase that shiny tip of the iceberg, right? Our job is to know exactly what's lurking underneath it.
So, to do that, we'll look at the allure of this current surge, dive into some major macro headwinds and risks, check out the 2026 regulatory reality, evaluate those long-term fundamentals, and finally, go over the critical questions you need to ask yourself before reacting.
Let's start with Part 1, the allure of the surge itself.
Check out this wild contrast in the current prediction markets. Following the Delphi Digital game theory dashboard shift to a cooperation regime, which is really just a fancy way of saying key players like miners and institutions are playing nice and coordinating, Bitcoin actually jumped 15%. But look closely at the numbers here. While traders are 99.8% confident Bitcoin stays above $66,000 in the immediate term, the odds of it hitting $86,000 right now, they're sitting at a tiny 0.1%. So the market is totally pricing in this current surge, but it's highly skeptical that we're boarding a runaway rocket ship anytime in the next few days.
And the daily movers perfectly illustrate this volatile reality. We're talking a market totally driven by short-term momentum. Sure, you've got tokens like NF Prompt jumping 37% in a single day. Awesome, right? But on that exact same day, tokens like ADCA are tanking by 51%. And even more concerning, the Ethereum unstaking queue, literally the line of people trying to yank their locked assets out of the network, has shot up by 72,000% in just 2 weeks. Nowhere around it, that suggests investors are heavily hedging their bets and hunting for liquidity. There is some serious tension under the hood here that a simple green candle on a chart just won't show you.
Which brings us to Part 2, the macro headwinds and risks.
Now, putting that cautious advisor hat firmly back on, this is the data that absolutely demands your attention. According to the CME Group, there is a whopping 94.9% probability that the Federal Reserve leaves interest rates completely unchanged at their next meeting. Central banks everywhere are sticking to a restrictive, higher-for-longer playbook. And why does that matter to us in crypto? Well, because high borrowing costs literally suck the excess liquidity right out of the economy, and we need that liquidity. It's the fuel required for any kind of sustained, long-term crypto rally.
And because money is so tight, we're seeing a really fascinating shift. Bitcoin is actually showing an increasing correlation to gold, with a coefficient pushing past 0.35. Essentially, both assets have entered this phase of neutrality. They're struggling to attract new capital because overall risk appetite has just completely cooled off. You can see this perfectly mirrored in the Crypto Fear and Greed Index, which is just kind of stubbornly hovering around 40 right now. In short, the market isn't treating Bitcoin like a high-risk tech stock, but it's also not totally embracing it as a safe haven either.
So here's the crucial takeaway. When money is tight, capital naturally flows towards safety and guaranteed returns. Right now, 10-year Treasury yields are sitting pretty at a very attractive 4.4%. Safe, traditional, risk-free yields are actively sucking capital away from digital assets. This exact macroeconomic gravity directly led to $148 million in Bitcoin ETF outflows in just 1 week. Think about it, it's really tough to justify betting on volatile tokens when Uncle Sam is basically paying you 4.4% just to park your cash. Sometimes, honestly, boring is just better for your wallet.
Let's move on to Part 3 and talk about the 2026 regulatory reality.
We are currently looking at a sharply divided global landscape. On one hand, you have the European Union rolling out their MiCA framework. This is huge because it allows for consolidated passporting. Basically, if an exchange gets authorized in one EU country, they're good to go across all of them under one unified rulebook. On the flip side, over in the US, we're still dealing with this incredibly complex product-by-product perimeter enforced by multiple agencies like the SEC and CFTC. Exchanges are forced to constantly guess whether a token is a commodity or a security, which just keeps the US landscape highly fragmented and, frankly, legally precarious.
And the clock is ticking very loudly in Europe. There's a hard, no exceptions deadline of July 1st, 2026. By that date, over 3,000 European firms, we're talking exchanges, custodians, brokers, the whole shebang, must have strict regulatory authorization. If they don't, they have to pack up and cease operations completely. Make no mistake, this is not a drill. It is a massive consolidation event that is going to wipe out non-compliant platforms and permanently alter the entire structure of the market. Now, this regulatory clampdown intimately affects stablecoins, which means it intimately affects you. Stablecoins aren't just a convenient trading pair anymore. Their regulatory status is now a massive liquidity and settlement risk for your personal portfolio. We're actually already seeing forced delistings of non-compliant stablecoins. At the same time, big institutions are adapting. Just look at Coinbase's new CSU fund. It's a tokenized, stable Coinbase credit vehicle built specifically to play nice with new SEC oversight rules. The writing is on the wall here. Compliance is the brand new primary driver of liquidity.
Okay, Section 4. Let's evaluate the long-term fundamentals. Ultimately, a lot of this really comes back to a concept known as sound money. Theorists like Saifedean argue that the true core value of Bitcoin lies in three main principles: scarcity, predictability, and a total absence of central control. See, unlike fiat currencies that central banks can just print at will, which, as we know, historically leads to crazy boom and bust cycles and inflation, Bitcoin's fixed algorithmic supply reintroduces a stabilizing, mathematically sound monetary principle for the digital age. And this completely aligns with the view of financial analysts and human rights activists like Alex Gladstone. As he pointed out on the Great Simplification podcast, Bitcoin is the lifeboat, not the iceberg. He looks at Bitcoin as this neutral, practical tool that protects everyday citizens globally from arbitrary currency devaluation and political deplatforming by failing governments or overly strict banking regimes. If you want to see this fundamental value in action, you really just have to look at the Global South. When the U.S. Federal Reserve aggressively hikes interest rates to fight off our own domestic inflation, it sends these massive shockwaves that inadvertently crush developing nations tied to dollarized debt. It's eerily similar to the Third World debt crisis back in the 1980s. As local fiat currencies collapse and the cost of basic commodities like food and fuel goes absolutely through the roof, everyday citizens in places like Argentina, Turkey, and Nigeria are aggressively adopting Bitcoin, and they aren't doing it to get rich quick. They're literally just trying to preserve whatever purchasing power they have left. All right, bringing us to part 5, the final stretch, questions before you react. Let's bring all this macroeconomic data right back to your own personal strategy. Think of this next part as your cautious financial advisor's survival guide. Question number 1. Have you actually confirmed your exchange's regulatory perimeter and stablecoin contingency plans for July 2026? Look, before you go chasing a sudden 20% token spike, you absolutely must ensure your platform won't suddenly lock you out or delist your preferred trading pairs because of that incoming MiCA deadline or an SEC compliance failure. If your exchange isn't proactively preparing for this, it's your capital on the line.
Question number 2. Does your portfolio actually account for a prolonged high interest rate environment? You really need to sit down and evaluate if a chunk of your capital is just better served sitting in risk-free traditional yields, like those 4.4% treasuries we talked about, while the broader crypto market battles this massive central bank liquidity drain. Seriously, do not fight the Fed just because a crypto chart happens to look green today.
Question 3. Are you investing based on long-term sound money fundamentals, or are you just riding short-term momentum and FOMO? You've got to be totally honest with yourself here. Are your trades backed by a deep, solid understanding of structural market mechanics, or are you just feeling the adrenaline rush of a 15% daily green candle? Let's be real. One of these builds lasting wealth, and the other is essentially just gambling.
Which brings us to our final thought for today. Will you let the highly visible allure of the surge blind you to the massive macro current shifting right beneath the surface? As a disciplined investor trying to navigate the 2026 crypto landscape, that is the absolute ultimate question you have to answer for yourself before you even think about opening your trading app today.